What's going on, everybody? Michael and Coco here. You're watching the Stock Market Brief Show. We don't show our faces all too often, but we wanted to come and say hello. If you're new here, welcome to the channel. We use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. In today's episode, we're getting pretty darn close to a sell signal. Found some interesting data that I want to share with you. We're going to keep today's episode short and to the point. Let's get into today's show. All right, everybody, welcome back to the computer. We are looking at a tweet that I posted earlier today. If you don't follow me on Twitter, you can follow me here at Mike P. Silva. We're going to be going over these two charts in a little bit more detail. It's the put to call ratio, signaling to me that, hey, we might be in for a period of consolidation or a subtle pullback, and I'll kind of put a bunch of ideals in this favor just so you compare yourself for if the market doesn't continue just ripping higher and higher going into the year end. So I want to just provide you with some insights as to, why we should just be a little bit more cautious going into the end of the year. All right, so first and foremost, let's just hop into this chart right here. This is the put to call ratio. The put to call ratio is the light blue line. The black line is actually the moving average, the 10-period moving average, so it smooths out that data. And what I called out here on Twitter, this is the first chart that I posted out. And before the trading day was actually over, I posted that the put to call ratio is getting rather extended down to 0.58. If you just take a look and put a horizontal line, there hasn't been too many times where it reached down to these levels in really the past 12 years or so. Now, the day did not end at 0.58. It actually ended up at around 0.6, I believe it was, or 0.61, which I'll bring into play here momentarily. But the reason why I found this spike to be important is because, as stated here on the tweet, this is a spike. It can be used as a contrarian indicator. An extreme spike to the downside lets us know that there is excessive bullishness, which is call volume, right, taking place in the options market relative to put volume. Right? Now, these spikes can be leading indicators into market reversals and or periods of consolidation. So I also wanted to post the picture of an S&P 500 for the last 6 times that this was actually triggered or that it reached these extreme levels. And as you can see, we posted right here a couple of times it went as the market was really just going sideways. And you can see here that we did see, it was an early indication that we did get some sell-side activity, then it came back up, and then we saw some more sell-side activity take place right there. So more times that it happened was down here at late 2010 to early 2011, and these signals gave us the early warning, but you can see we still continued to press higher and higher. Then we got into some pretty gnarly volatility there, and then we dropped down from that point. And then there in early 2010, it pretty much tagged the top right there. Now, that was when I posted the chart that we got those extended down readings, but I want to get into a little bit more detail. This right here is what I like to call, just a buy or sell signal. And when we got to 0.95, just a few trading days ago, I let everyone know that the buy signal was basically triggering. And once it crosses down through green, that is that buy signal. We got it on Monday, I think, of last week. And then we got to see that big rally. Now, this red line, 0.8, is the sell signal. So when it crosses down through there, that's more of a warning. But when it turns up and crosses back through it, that is the quote-unquote sell signal. And it's not really, it doesn't mean go buy a bunch of puts or do anything crazy. But, consider hedging, consider increasing your stop losses, potentially taking some profits there too as well. Okay, so we ended up at 0.64, on the day for the blue line, which is the put to call ratio. And you can see here, it's far and few between that we get those overextended areas as well, but we get them more frequently than what we had earlier in the trading day. Now, what I wanted to show you was each time that this crossed over here, from underneath to above 0.8, what that kind of looks like. We had a little bit of chop right here, right here, right here, right here, and then quickly right there and right there. So I wanted to show you on the S&P 500 what it actually looks like when the 10-period moving average crosses up through 0.8. All right, so here you can see some interesting things taking place. So first off, yes, we had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times that it happened within the last basically 2 years, and now we're getting another trigger here potentially very shortly. We haven't got it yet. And you can see here early 2020, it gave us that little heads up notice that we're going to see some volatility, and it sold off. Market recovered, right? And then we got another trigger, and then now is right before that pandemic crash. A couple other times we saw this big run up, came down, bounced up, but then we saw more sell side shortly thereafter, this trigger right there. Right here in early September, we caught it right here, and then we saw some more sell side activity. Right here, we saw some more sell side activity. And these two times happened, the dashed lines, you can see here that these actually did not catch more sell side activity. And I'm going to go into detail as to potentially why and why it's important to pay attention to those. And then these two times, obviously, we saw some more sell side activity too as well. So, 1, 2, 3, 4, 5, 6, 7, 8 out of the last 10 times, we saw some sell side activity take place. So the next trigger, just, there's an 80% probability as of right now that we do see some continued sell side activity. Now, what's important to point out here is these two triggers that didn't work, look at where price action was at that given time. Price action was already selling off. Then the put to call ratio gave us that quote unquote sell signal. It's a contrarian indicator. So it basically lets us know that, hey, there's excessive bullishness in this specific area. And you can see after a sell-off, that actually marked somewhat of a short-term bottom, and then we started rallying, or a bottom, and we started rallying. However, the other times was triggering from after a big run-up. So you can see here, one run-up, but then right here, run-up. Here, it was actually a big run-up, and then it started coming down, and we saw some more sell-side activity. Right here was a big run-up. Right here was a pretty big spike. Right here was a big spike. Right here was a big spike. And now we're getting close to that sell signal, and we're coming from an area from also getting a big spike. So it's not that you want to put too much weight on this, but we're going to get into some more charts here to help really kind of hone in as to why you should potentially be, pulling some profits, or, where's the better risk to reward? Is it from the long side or the short side right here currently in the market? Okay, so hopefully that gives you a little bit more detail as to, just the validity of watching this put to call ratio in the markets. Now, if you look at the S&P 500, a couple things that I want to point out is, obviously, we just come in from a big run up. Now, the sell signal wasn't triggered yet, as you can see, right? We're looking at the CPC right here. The blue line the blue line is pretty significantly down, but the black line has not yet crossed down through 0.8 and crossed back up through it. These overextended areas potentially let us know of a short-term period of consolidation and or a reversal coming into play. Now, when we look at the S&P 500, here's a couple concerns. We talked about this on last night's brief. First off, we've already had a really big rally for the week. These blue lines are the expected move that the options priced in, and 70% of the time it expires. Those options will expire on Friday of this week within this area. So we'll see, and in one single day, technically 2 days, we touched the upper edge, and you can see we started to get a little bit sell side activity. So this right now, price is in its happy place as of right now. If we start getting outside of that, you might get some more dynamic hedging that takes place, and it could also perpetuate more buy side activity to get a more aggressive squeeze to the upside. Now, as it stands right now, prices obviously got rejected from this area. And if you just look at the overall, 1, 2, 3, 4, 5, 6 trading days, it's been completely vertical, the Santa Claus rally. And if you just take a look down to the bottom of the screen, you can see here, this rally has been met with just declining volume, which is another interesting thing. I know that we're in the holiday season. You typically get less trading volume, but still important to be just mindful of in this current environment. Now, if you're thinking about going long right here, you got to ask yourself, is this the best entry right here? Are we going to continue ripping higher and we're not going to come revisit these areas? I mean, to me, it's highly unlikely, but it's possible, right? So we broke out of this trading range, right? And, if you enter in right here and we keep rallying, cool, awesome. But you gotta wonder, like, if I enter in right here, what is the chance of us continuing to rally, or that we potentially see a pullback to here, or even deeper to the 20-day moving average or the 50-day moving average? And to me, from a risk to reward standpoint, from already hitting this upper edge of the expected move, from a couple indicators that we'll be going over and one that I already posted, to me it seems like, hey, this could be a period of consolidation, or, you know, potentially flagging into an area of previous support. So price can come down, or it can, you know, retrace a little bit, and then it can set up for, you know, another potential rally. If you take a look at the 15-minute time frame, we're still completely vertical. RSI kind of died off a little bit. We talked about, hey, if we get a gap up, I wouldn't be surprised to see some sell side activity. We got that, but it was really just sideways price action. As you know, it's a high, a lower high right here. We'll see what the futures market brings in store, but overall, we're in a short-term bullish trend. The 5-day moving average is starting to accelerate to the upside. So that's good right there. So you can start watching those levels. For example, right here. So 470 to 471 for potential area of support. You know, we might get down through 476. We come down here to retest it. If that holds, we might get a little bounce and then off to the races. Or you got to watch for a potential breakdown too as well, right? The RSI is just slightly above 50 at this particular point in time, but you got to take note of the PMO. It's been just lacking momentum here as the price has been accelerating to the upside. All right, so let's continue on. A couple of things that I want to point out. We have the VIX right here, falling wedge structure still at this particular point in time. A positive divergence taking place on the RSI at this particular point in time as well. We have some gaps above us. That remains the risk. You know, it's very typical to get gap fills, especially here on the VIX at some point, and that would be a pretty aggressive spike if we got it here in the near future, but we'll see what takes place. You can see this blue horizontal line. Many times it acted as resistance and support. You can see here, and these times right throughout here. So if we start getting back above this 1850 and 19, we might be in for a little bit of a pop. The other day I talked about how the Bollinger Bands were contracting, and contraction leads to expansion, and that's non-directionary bias, right? You can go plus or minus, and as it stands right now, we are still contracting rather tightly at this particular time, tighter bands than we were the previous trading day. So be mindful that we're probably going to be getting, you know, somewhat of a, you know, an expansion here in the very, very near future. If you take a look at the 11 sectors in the S&P 500, the top three, two of them are way more defensive names. And if you just go down the list a little bit slightly more, real estate was also in there, another defensive name. And you see technology, you know, is down there at the bottom. And if tech isn't performing, that does put some pressure on the S&P 500, as well as obviously the Nasdaq 100 and the Nasdaq Composite. You can see here all the indices. Where did we finish? Well, we finished relatively flat for the most part. It was a pretty much nothing burger kind of day. Dow Jones remained up. Meanwhile, the other indices were basically down, as well as the VIX too. Now, I just want to continue on. I want to look at the dollar really quick and give you some insight into this. The dollar has been flagging here, and it's been flagging, consolidating really for now a month to just over a month. And this is important because this is a continuation pattern. Okay, continuation pattern suggests that we will break out and head higher. Is that guaranteed? No. But the reason why I find it to be important is these three purple lines. And there's more history of this too as well. But I want you to pay attention to this purple line from that point and this point. What happens when the dollar rose? Well, the S&P 500 started seeing weakness, right? So when the dollar starts ripping higher at a pretty fast rate of change, you get weakness in the S&P 500. At this point right here, the dollar started rising, right? And we saw more sell side there in the S&P 500, creating another low there. And then at this point, the dollar hit its upper range of this pattern. And you can see here, as it started to sink, that was actually marking the bottom of the S&P 500 at this particular hammer candle. And as the dollar started sinking, the S&P 500 started rising. Now, the reason why I'm pointing this out is because we're at the bottom edge of this. We saw a bullish looking candle. It's been consolidating for 3 days here. So it's going to be more upwards momentum to potentially break out of this 9650 structure. And if it does, that could potentially put pressure on the S&P 500. So that is something important to watch moving forward. Let's continue on at a couple other indicators. If we take a look at the NIAD, The NIAD right now, this is the advanced decline line. It helps us get a good idea of internals. And what it's telling me, you know, we talked about the bullish divergence on the RSI previously, but now you can see price has been ripping higher here. But the NIAD cumulative line has actually not actually putting in a higher high right here. You can see a low to, sorry, a high to a lower high, where right here you have a high to a higher high. So you do have a divergence taking place there on the advanced decline cumulative line. If you look at that advanced decline volume index, very same situation. As price is continuing to rally, you can see here the advanced decline volume line is actually putting in a lower high there as well. So also you're just seeing a rally take place towards the end of the year. This could be a low volume rally. We could get drift to the end of the year, but just take note, like, do you really want to buy long into something where we're seeing weakening internals taking place? You know, maybe it's part of your strategy, maybe it's not, but at least if the market does roll over, you're not going to be surprised at the fact that it actually did. You'd be aware, and if you're going long at these particular points, at least you might have a stop loss a little bit tighter so you can play the momentum to the upside, but if it starts to turn, you're just taking a small little loss, which is totally normal. If you take a look at SPIP over GOVT, I like to apply a 10 period rate of change on this and wait to see if it gets above 1.3 to 1.5. The last time it's been doing that, it gives us a little bit of a heads up notice of a potential volatility spike. And as we see, we continue to move a little bit higher here. We're not quite there, but it's something to still pay attention to. As you can see, the VIX there is kind of wedging. So if we do get up into this area, just be on notice, right? All right, let's continue on. BPNDX chart, it did click a little bit higher here too as well. We're kind of moving into that overextended territory. We're not quite there yet, which tells me that we can still have more room to potentially head higher, but just take note where it's at. These aren't the best areas to go long. You could find better entry points, and that's kind of the whole point of this video. If we take a look at the Qs, okay, on the daily time frame, broke out of this channel, broke out on low volume, and now we're starting to see a little bit of weakness, right? This candle structure right here is called dark cloud coverage, where you get a big bullish candle, right? Momentum to the upside, but then you get a gap up, right? And then what happens is the red candle tries to pierce halfway through the body. Now this one did not pierce fully through the half line of the body, but it's still a bearish type candle. I think to really be called a dark cloud coverage, you'd want this red candle to be pierced more through it. And basically the more that it's pierced through it, the more potent of a reversal this could potentially be. So at this point, it's not giving us much as it broke out. We're seeing a little bit of, sell side activity into it, bounce from this previous area of resistance, it became support. Now, if it starts coming in harder tomorrow and we see a spike in volume, that's a different story, right? That means basically we're getting low volume breakouts, and then as it comes back in, we're seeing increased volume. That would actually be more bearish in my opinion. Now, if you take a look at the 15-minute time frame, price not doing much, right? Just kind of consolidating. We could potentially be just going through that period where we get, just a low volume drift up higher and higher until year end. Okay, but as it stands right now, short term 5-day moving average is turning up. PMO, it's still sinking off, but it's still above that 0 marker as it stands right now. So what can we potentially watch for? Well, just watch for this level right here, which is about 398, 399. If that starts getting taken out and we start heading lower, by the time that actually would come down here, we'd have the 5-day probably creeping up. So that would act as an area of potential support, right? But if it starts getting taken out with some aggressiveness, you want to start looking at this volume shelf profile here at around 387 to 388, this kind of zone in there. We'll see if that comes to fruition here in the next couple of days. If we take a look at the Nasdaq composite, this is also interesting. These are a couple levels I mapped out not too long ago, and you can just see we talked about this falling wedge into an area of support, and we just ripped, bam, straight up. And the price hasn't really digested. Now we're starting to see it kind of pull down here. This could literally be just another one of these moments, right? But just take note, right? It just got screaming overextended, both on the RSI, and it came right into these previous areas of resistance. Remember, resistance is a web, right? It's not just like a specific number. I know people look for that exact spot, and every once in a while they're going to hit it, nail it perfectly, but just be mindful that it's more of a zone, and we're still really kind of within that zone. You can see this could be considered a bull trap, right? If the price actually starts coming back in, then everyone's going to look at this and say, yep, that was a bull trap. But as it stands right now, this could just be literally pulling in a little bit, could come down, pull back. This could just be flagging. Okay, so start looking for areas of potential support that you can start going long into as it stands if you want to trade the current momentum. And the current momentum in the short term is obviously up. Now, if you take a look at the IWM put in a somewhat of a shooting star type candle, but you can see here the body just traded within the previous trading day's body. We had a long upper tail. All right, so hammer candle, inverted hammer candle. We tagged the upper Bollinger Band, couldn't get back above that 50-day moving average, and we started to see some weakness there. Volume still rather low. Just watch for tomorrow. If we get some continuation to the downside with increased volume, that would be a little bit more bearish, obviously. Take a look at the 15-minute time frame, still above that 5-day moving average, and we still haven't filled this gap right here, which can act as a level of resistance. But overall, we're still within this trading range. So if we come right back down here, it's not really giving us much data as it stands right now, right? We're just still kind of hammering back and forth. The 5-day moving average is trying to base right here. You can see it's trying to base as of right now and potentially keep price above it, and we start to obviously turn this thing up, and then that's obviously very bullish for the IWM in the short term. If you take a look now at crypto, I want to get into this a little bit. The sailor to shift ratio the other day was on that buy signal, but we said, hey, it's Monday, a lot can change. We need to have it close above there on a weekly basis, and it still can, but just take note that it obviously came back underneath, and we still haven't got that confirmed signal. We didn't get above that 52,500. We saw some increased sell side activity today, but you can still see it's still above the previous low of the previous trading week as it stands right now. This could be potentially forming, like I said, a bear flag, so be very mindful of that. If we actually take a look at this chart here, this green line represents the anchored VWAP from the very beginning of this year. And why I'm pointing this out is you gotta, like this, the anchored VWAP, for those that don't know, it measures price, time, and volume. So basically it's saying that this number right here, right, 45399, the average buyer is slightly, the average buyer of 2021 is slightly in green. The average buyer is slightly in the green. Now you got to kind of ask yourself, hey, if the average buyer of Bitcoin goes underwater, what kind of, how would people respond to that? So that means more and more people are losing on their positions, potentially more fear could take place. And if that actually happens, if price starts getting under 45399, and you can see here it acted as support. Previously it acted as resistance, it acted as support in this little zone here. If price gets beneath this, you got to think, hey, that might actually flush out more people where we can get another leg down. And that another leg down could very well be that kind of bear flag, that I'm kind of that I drew out right here. So if we get a flush down, I mean, that sets it up to potentially come back to this 40,000 range. So that is something to just obviously be mindful of. I couldn't tell you if that's going to be the case. The other day we talked about, contraction leads to expansion, and you can see here price contracted, and we just recently expanded to the downside. Remember, contraction expansion, it's non-directional bias there. If we take a look here on the daily chart of Bitcoin, one that I shared the other day, this is also something that we talked about, right? Price was consolidating. I like the breakout, but I didn't like it because of the low volume. And look at the price here. It actually came in and you saw increased volume. You see the relative strength line kind of slacking right there, and we're still holding right around that 200-day moving average as it stands right now. So not the greatest looking break to the downside, but yet price is still holding some key levels at this particular point in time. If you take a look at Ethereum, we also mentioned how price was contracting very tightly. However, it could be potentially forming a bear flag right there we talked about. I didn't like how this was below the 50 EMA. The relative strength line was weakening. right? Contraction leads to expansion. Expansion took place, but it was to the downside. So where can we potentially go? Well, we might go test this trend line again, which is 3,600 to around 3,700, that kind of zone in there. But we're still above a rising 200-day moving average at this particular point in time. Perhaps we're just getting a little flush out before a nice rally. That's always possible, but just as it stands right now, I mean, not the greatest sign. We want to see this turn up. We want to see the Taylor to shift ratio. We want to see that get back above 0. And that's what we want to see take place. And then, we'll be obviously in a better position. One thing that I also want to call out here before I close up is there's been plenty of times where I started to show that sometimes Bitcoin, for some reason, led the price of the S&P 500 by a few days. And what I find interesting here is the S&P 500 clipped to an all-time high today, right? It didn't close there, but it hit to an all-time high. And interestingly enough, Bitcoin, which is also a risk asset, started to sell off. So is Bitcoin's price action and Ethereum's price action giving us a leading indicator that we might see some more sell side take place in the S&P 500? And you really start to wonder, and you start to stack all of these things that are taking place. For example, the put to call ratio, right? We talked about various indicators. This one hidden kind of an extended area to the downside. We talked about the advanced decline lines. We talked about the positive divergence on the VIX. We talked about the potential for the dollar rising right here. I mean, just put all these pieces together and ask yourself, hey, should I go long right here? Or should I wait to see if we do start to flag, consolidate? I'm not calling for a stock market crash, but I'm just trying to point out where you can potentially take entries that give you, once again, a better risk to reward. And as it stands right now, it seems to me that the reward for the trade would be more to the downside than it would be to the upside. That's all I got for you on today's episode, everybody. Be careful out there, stay safe, and I'll see you back here on the next episode.